Welcome to Beyond Wall Street, presented by Arixa Capital, where expert investors make their unique investment strategies easy to understand. I'm your host, Jan Brzeski, and today I'm talking with Dani Evanson, Managing Director of Align Finance Partners. We'll be discussing generating income from financing affordable housing. Dani, it's great to see you. Thank you for agreeing to be interviewed today.
Thank you so much for having me on. I'm excited to talk to you again.
I'm looking forward to going into your strategy because it's really an innovative one and one that I think people may not find on their own without being shown how it works. So why don't we just jump into it? For starters, if you could just talk a little bit about your personal background and your career path, that would be a great start.
I started actually as an accountant with Ernst & Young, and I quickly realized I was very much attracted to real estate investments, and the opportunities that real estate could afford somebody with a finance background. So I've been in real estate for 23 years, but over the last 5 years, I've really focused our business attention to the affordable housing industry and the opportunities within the affordable housing sector.
Talk to us about Align Finance Partners. What do you do at Align, and maybe a little more detail about the affordable housing financing that you're doing?
Sure. So Align Finance Partners was created with myself and a few partners that had a very large investment in an affordable housing portfolio of over 25,000 affordable housing units. We've all been partners for 11 years, but a few years ago, we realized that there is private capital, private investors that have a very difficult time accessing opportunities within the affordable housing sector. Affordable housing is traditionally financed and capitalized with a loan and then other sources of capital, like grants, bonds, low-income housing tax credits. So there really isn't opportunity for private capital to access this particular space within real estate.
So we're talking about apartments and that are affordable rents relative to market rate apartments, right? So it's not necessarily a Class C building. It can be a really nice building we're talking about, right? Are these mostly new construction buildings?
We focus on a lot of new construction. So the properties that we loan capital to will be newly constructed affordable housing. And going back to the affordability factor and what differentiates affordable housing from market rate apartment buildings is that the tenants are restricted to those that earn a certain income relative to that area.
So this is exactly what all of our political leaders are talking about, housing that people in different types of jobs can afford, as opposed to the rents on a new construction apartment building might be out of reach for a lot of people that live here. And you are aiming to generate tax-exempt or partially tax-exempt returns for your investors. How do you generate those returns?
We make a loan to a borrower that's building or buying affordable housing. And when we make a loan, we split the loan into two pieces. Let's call that an A certificate and a B certificate. And we sell the A at a lower rate than what we made the loan for. And then the difference between that low rate and the face rate of the loan goes to the B certificate holder, which is our investors. Our investors are holding B certificates. And that becomes a high yield debt investment for our investors on a tax exempt basis.
So let's go into the details a bit. Let's find a sort of a sample project, if you could think of one. Maybe give us an example of how many units it is and where it's located, and we can go into some details using an example.
So a project would be typically they're over 100 units per project. Let's stick with 100. I just think it's an easy mathematical number to equate the rest of the math that we're going to be using in this example. The location can be anywhere. I mean, affordable housing can be literally anywhere in the nation. For us, we tend to focus on submarkets that have a minimum population of 100,000. Those are not relatively enormous cities, but we tend to stick with, qualified cities that have work centers and employment and sort of a healthy vibrancy to it. We're also looking for projects that have rents that are affordable rents that are substantially different from market rate rents.
Give me an example of a couple of cities where you've done projects and financings in the last year. What types of cities are we talking about?
So we've lent in Seattle, which is a very strong market, Riverside, California. We're looking at Los Angeles, San Jose. So, really quite urban, dense markets.
So someone's building a 100-unit project in Seattle or Riverside, California, and they've found the land, they have their bank loan all set up, right? They've probably won some tax credits as well to help with the financing. So where do you fit in? What's the financing that you're providing?
We're equivalent to the bank financing. So we're a construction lender and a permanent lender for once the project's stabilized and the construction loan is closed.
Okay. So the total cost of the project is whatever it is. What percentage of the total cost is coming typically from equity and tax credits? And then what percentage is coming from the loans that you're involved in?
Let's use the example, 100 units. Let's just assume for a second that they're each going to cost $1,000 to build. Okay. So let's pretend we're playing a Monopoly game for a moment and using numbers that obviously are so unrealistic, but for mathematical reasons. If the project costs $100,000 to build, we're typically lending on average between $50,000 to $60,000, and then the tax credits that are earned by virtue of having an affordable project being built is going to represent the delta, the difference. So if we're going to be lending up to $55,000, $60,000, the tax credits will get you to about $40,000. And then if there's a gap, meaning between the credits and the loan, there's still money that needs to be raised, they'll get local grants or others donated money to complete the project.
That sounds like a very attractive position if you're the lender at 50 to 60% of the cost of the project. That seems like something that our viewers would be very interested in, because our viewers tend to be interested in income and alternative investing and attractive returns, but in many cases trying to not take too much risk. So you provide that financing, and then it sounds like there's two phases, right? There's the construction phase, and then once all the tenants are in and there's cash flow in place, you're going into a permanent loan. Can you walk us through, where do you end up with, once it's stabilized, what's your position in the capital stack of the project?
So affordable housing's not like market rate multifamily and apartment buildings. It's dramatically different. It's funded differently, it's tenanted differently, and it's valued differently. Just hitting on the risk profile, one of the most interesting things that we were attracted to when we first entered into affordable housing 11 years ago was that the default rate, meaning the loan default rate in affordable housing, is 0.01%. It's the lowest default rate in all credit, credit being lenders who are making loans. So the default rate is very, very low. And the reason for the low default rate is because the rents are predetermined. The communities, the bankers, the borrowers, we all know what the rent is going to be projected, and we can see, and it has a very low volatility in that. That's really important, so you know your income stream and you can see it out 10 years. And there's going to be a little bit of fluctuation, but not a lot. And that helps lenders like us get comfortable with the operating income that's available to service the debt.
So in our example, the finished property was worth $100,000, and your loan originally was $50,000 to $60,000. After it's stabilized and permanent financing is in place, is your loan still 50 to 60,000, or is there a different permanent loan from a bank in place, or is your loan the permanent loan?
We call ours full term. So that's through construction, through permanent financing. So our loan term can be as high as 18-year paper, which is very long term. And in affordable housing, there is a minimum 15-year compliance period once you stabilize the property and have it with tenants. So the construction period's roughly 2 years to 3 years, and then you have a 15-year compliance. So we have to term our paper to an 18-year paper.
Okay.
So it's a long income stream for owners and holders of that paper.
How long would the investors expect to stay invested in this strategy? Do your investors need to be prepared to be invested for 18 years as well?
I wish they were that patient, but I don't think any investor has the appetite to have almost 2 decades worth of an investment with a single strategy. So our fund in particular has a 10-year life, which is to sell the portfolio of B certificates. And we believe that if the portfolio of B certificates has a high yield coupon, we'll be able to liquidate that in the market. So we intend to not hold beyond the 10-year term.
Got it. And I know that in the market rate apartment area, apartment loans are very low cost today, 3% or maybe even lower. What is the rate that the borrower pays on the permanent loan once the property is stabilized?
Like most lenders, we are subject to the market interest rates. And right now our permanent financing is between 4% and 4.25%.
Okay.
That's tax exempt interest rate.
I see. So the borrower they are paying a bit higher rate than what the market rate permanent financing would be.
They're getting a fixed rate for 18 years. So while market rate projects are going to have potentially sub 3% or 3.5% rates, it's typically for a shorter term. So the max term you're going to get on a multifamily market rate project is a 10-year term. So we're effectively almost doubling that term with a slight premium in rate.
And if
now the
it works,
benefit,
sorry, go
right?
ahead.
But the benefit to our paper versus market rate multifamily paper is that our interest is tax exempt.
So let's say that you've got a 4.5% or 4.25% rate. What does that end up meaning for the investor? What kind of return are they getting, and how is that income treated from a tax perspective?
Well, before I go to the returns, let me talk about tax treatment, because I think that's really, really important. And that's what differentiates investing in debt that's for affordable housing versus any other type of debt. The tax treatment for having invested in debt instruments for affordable housing is tax exempt at the federal level. And then if the project is in the same state as the investor, so let's use the California for a second. If the project is based in California and the investor is also a California resident, it is state tax exempt as well. So for residents that are in high income state taxes like California, finding investments in debt for affordable housing is a home run in the tax efficiency perspective, because you're now federally and state tax exempt for that stream of income. Really important. If you're an investor in California and the project's in Oregon, right, Colorado, then you will have state tax level income implications, but you will have federal exemption.
Does the investor get to choose which projects they want to participate in, or are they going to participate in a portfolio of projects, some of which may be in their home state and some of which are outside?
So for this strategy, it isn't a portfolio because individual investors don't qualify to hold tax exempt bonds. So what we do is we create a fund in order for investors with smaller capital allocation to access the strategy. So the truth is you're going to have a wide variety of states and you're not necessarily going to have an entirely California focused fund.
What kinds of returns are possible for the investor in general? And I think tax exempt in California, as you say, is very special, and with federal rates probably going up, it's probably going to become even more appealing. So what kinds of net returns have investors gotten in the past in these types of strategies?
So if it's a 4.5 rate, the investor will probably net take home somewhere between 2.5% and 3% yield, tax exempt, depending if it's state level or not. We just went over. But what we do and what we specialize in at Align is selling tranches. So think about this: if you have a loan for $50, because $50,000 if it was a $100,000 project, we'll sell a senior piece and keep the residual. And what that does is it creates a high yield B piece. So for us, we're targeting a higher yield by virtue of selling a lower risk, lower coupon to Wall Street. So we're selling what we call A certificates to other banks and financial institutions that are looking for core, very stable, lower risk return instruments. And so by selling them at, if I have a 4.5% interest loan, I can sell it to them for 3%, and I can take the delta and put it to the B piece for the high yield.
And the high yield being what type of range has that B piece traditionally been able to earn for the end investor? Just a range would be fine.
So they're ranging between 8 and 12% right now.
And that's with the favorable tax treatment that you were talking about.
Yes.
Okay,
right.
That's really pretty remarkable, because that is indeed a high return, and they're getting quarterly distributions. Is that right?
We provide quarterly distributions, but other lenders and other lending platforms might do monthly. So it's really at the election of the fund manager.
So you're ending up investing in the smaller part of the loan,
mm-hmm.
but it's still at a very reasonable loan to value, and you're getting a higher yield because Wall Street is taking the bigger part of the loan. They're getting a lower yield, and you're keeping these B pieces, which have a high yield and the favorable tax treatment. Is that pretty accurate?
That's accurate. The one thing I would say is that we want to make sure that when we're talking about loan to cost and loan to value, they're two different things, especially in affordable housing.
So loan to value can be lower than cost in affordable housing, but you don't end up owning it unless there's a default. What would cause a default?
Well, there's a lot of belt and suspenders when it comes to default. And the reason for that is because you have tenants in a property that need housing, and the eviction process is very complicated and one we don't want to support. So for us, a default by the borrower means we're going to replace the borrower. We're going to replace the management. We're going to replace the operations to make sure that somebody's in there who knows how to operate affordable housing. And it's extremely rare that you'll have a default because of a property issue, because it was recently constructed with building permits and consultants and all sorts of other people involved to make sure that it's being built to the quality and standard that's required.
What's the hardest part of your business right now if you had to single out one thing?
Deal sourcing, right? Being attractive compared to agencies and large banks that have a 0% cost of capital, where any private lender like ourselves has a cost of capital that we have to contend with and we have to be fairly, aware of.
So getting that 4 to 4.5% rate that you're looking for, there might be a lot of projects going on, but it's only a subset of those that can and that want to and are able to pay the 4 to 4.5% rate, and the banks are kind of undercutting you a bit. So there's a chance that you could end up with less than your 8 to 12 target returns, but it's still tax exempt with a very low default rate. Tax exempt based on what we described earlier. So it's not a It's not a risk of loss of principal so much as just lower tax-exempt returns than you thought.
I would agree with that. I would say the risk in a strategy like this is not meeting your high yield target, whether that be 7 to 10, 8 to 12, that's all high yield.
Right.
And it's you don't execute the second part of the strategy, which is selling the A and keeping the B subordinate position.
What's the single biggest risk to your strategy? We've talked about a couple of areas where there's some risk, but how would you describe the single biggest risk?
I think the single biggest risk in our strategy is not getting to the high yield paper. That's our business model. Our business model isn't to provide low 3 to 4% interest, tax exempt interest investments. It's to offer high single digit tax exempt yield. And in order to effectuate, you really have to execute not only on making the loan, but selling off that A piece in order to retain the B high yield.
So Dani, what's your favorite thing about your job and about this investment strategy?
My favorite thing about the job is absolutely making an impact in the world of affordable housing. I mean, knowing that we're creating additional supply of desperately needed housing is something I feel really good about.
This has been very interesting. It's a very unique strategy with very special tax treatment, and I want to thank you for taking the time to tell us about it today.
Thank you so much for allowing me to share it with you.
I'm Jan Brzeski, and you've been listening to Beyond Wall Street.